Most people think banks make money in a very simple way. You deposit money into a bank. They keep it safe. Then they lend it out to someone else at a higher interest rate. And the difference between what they pay you and what they charge others is their profit. That's the basic explanation, but that's only the surface level. Because the real system runs much deeper than that. When you deposit money into a bank, it doesn't just sit there waiting for you. Banks operate under something called fractional reserve banking. They are only required to keep a small percentage of deposits as reserves. The rest of the money can be used. Now think about what that actually means. Your money is not just sitting in a vault somewhere. It becomes part of a system that is constantly in motion, being used, recycled, and re-entering the economy. But here's where things start to change. Because banks don't just move money around, they also help create it. When a bank gives out a loan, they are not always taking someone else's deposited money and handing it over. Instead, they create new money digitally. Let's make this simple. A bank approves a $10,000 loan. That $10,000 did not exist in physical form before. It is created as a number in the system. The borrower receives it, spends it, and it starts moving through the economy. So in that moment, new money has been introduced into circulation. Now pause and think about that for a second, because this changes how you understand money completely. Money is not just something that exists in a fixed amount. It is something that can expand. And this expansion is one of the most important forces in the global economy. Now let's look at what happens at a larger level. Banks don't operate in isolation. Central banks, like the Federal Reserve in the United States, control the broader money system. After the 2008 financial crisis, the global economy was in serious trouble. Banks were collapsing, credit markets froze, and confidence in the system dropped. So central banks stepped in. They introduced something called quantitative easing. In simple terms, they created large amounts of money and injected it into the financial system, not always by printing physical cash, but by increasing liquidity digitally. This helped stabilize the system, but it also increased the total amount of money in circulation. And when that happens, something important occurs over time. Prices begin to rise. This is inflation. And inflation is often misunderstood because most people think prices rise randomly. But in reality, inflation is closely tied to the expansion of money supply. Now let's connect this to real-world history. In Zimbabwe, the government printed excessive amounts of money over time. At first, it was meant to support the economy, but eventually it spiraled out of control. Prices started rising rapidly, then extremely rapidly. At one point, prices were doubling within hours. Money lost its value. People were carrying large amounts of cash just to buy basic items. And eventually, the currency became unusable. In Venezuela, a similar pattern occurred. Economic instability combined with aggressive money creation led to hyperinflation. Again, this wasn't random. It followed a clear mechanism. Too much money in the system reduces the value of each unit over time. Now, most modern economies are far more stable than this. But the mechanism still exists. Money supply can expand, and that expansion affects purchasing power. Now coming back to banks, where do they actually make their money? The first and most obvious way is through interest on loans. When you borrow money, you don't just repay the amount you borrowed, you repay more. That extra amount is profit for the bank, and this happens at massive scale, across millions of loans, every day, every country. The second way is through fees, account fees, transaction fees, late payment fees, maintenance fees. Individually, they seem small, but when you scale them across millions of users, they become extremely powerful. The third way is more subtle, and it's often overlooked. Banks influence where money goes. They decide who gets approved for loans, which businesses receive funding, which industries expand, and which ones struggle to grow. So in a way, banks don't just participate in the economy, they help shape it. And that's a very powerful position to be in. Now here's something most people never consider. The system itself depends on growth, because when the economy grows, more money is moving, more loans are taken, more transactions happen, more opportunities are created, and that means more profit across the system. This is why lending is such a core part of modern finance. It keeps money circulating. It keeps the system active. And that activity is what allows the system to function. But here's the deeper insight. Money isn't just about earning. It's about understanding how it moves. Because once you understand how money is created, how it flows through the system, and how it expands over time, you stop thinking about it as something static. You start seeing it as a system with rules, a system with structure. And the people who understand that system are always in a different position, not because they earn more from the start, but because they understand how to navigate it. And that is the real difference.